Hey, how are you? I'm Duncan McPherson and welcome back to my channel. Today we're diving into tax treaty blunders, traps, and hidden gems that I see over and over again in my practice. I'll try to make this as painless as possible for you, but fair warning, some of this stuff is going to sound a little bizarre for you, so just please bear with me. And as always, before we get rolling, don't forget to hit that subscribe button and ring the notification bell if you want more tips on how to survive and thrive in the Canadian tax system as a U.S. corporation or an individual. Or if you'd rather cut through the nonsense and get expert help right now, contact me at MacTax.com and let's get chatting. All right, let's get right into it. Treaty blunders and hidden gems. I'm going to attack this stuff chronologically by treaty article. Article 2 covers taxes affected under the treaty, and it took a wild turn in December with the Bruya versus the United States case, where the taxpayer actually won against the IRS. In short, one of your fellow U.S. citizens living here in Canada successfully used the Canadian-U.S. tax treaty to claim a foreign tax credit against his net investment tax, aka the Obamacare tax, and he won it in court. Boom. Okay, this is big for me. Up here in my practice in little old Toronto, I have multiple clients that are paying thousands of dollars a year in Obamacare tax that will no longer have to pay it. Pardon me, net investment income tax. We're not supposed to call it Obamacare as professionals. But you can see how this is huge, right? Well, don't crack the champagne just yet. The IRS is likely to appeal this case. So what does this mean for you? Well, it just means that if you want to rely on this case for the 2024 tax year, proceed with caution and keep an eye out for the appeal. Article 4, Treaty Tiebreaker Rules. This is the one I hate because when it comes up, it's always really ugly. I have personally seen cases where the taxpayer would have been considered a Canadian resident under any other tiebreaker rule except the first one. And what's the first rule? Permanent home. I have seen people, for all intents and purposes, were residents of Canada, but they didn't have a permanent home in Canada. And they got hit with brutal tax consequences because of it. Essentially because under Canadian tax law, they couldn't tie break to the U.S. and were considered a resident of both countries and had to pay tax on large portions of their worldwide income in both countries. So if you have clients or you are personally on the fence between Canada and U.S. tax residency, make sure they or you have a permanent home in both countries in the year that they move down to the States. Because sometimes, and especially in this instance, where you sleep at night determines where you pay tax and how much you pay. Article number 6, income from real property, otherwise known as real estate. If you're renting out property in Canada, listen up. This is so important. I've actually already created 4 videos on how non-residents are taxed on the sale and rental of real property in Canada. So if you haven't watched them, go watch them if this applies to you. Now, you probably already know that rental income earned in Canada must be reported in Canada and tax must be paid on the income, whether it's earned personally or through a corporation. This is well known, basically very obvious too. But you have no idea how many times I have seen U.S. CPAs that believe because they are reporting the rental income in the U.S. on a 1040 or an 1120 that they don't have to file and pay up here in Canada. But newsflash, that is completely wrong, and don't buy into it if this is what you are told. If this has happened to you or somebody you know, please go back right now and watch my previous 4 videos. It's a nightmare scenario that you definitely do not want to be in. Now, okay, fine, you're in this scenario, but you should know that CRA gives you one chance to bring all of this up to date and get it fixed. You'll only have to pay interest, no penalties. So fix it before CRA changes their mind and no longer offers you the one shot to get it fixed. Article 7, business profits, a hidden gem and a GST trap. If you're a U.S. corporation or an individual running a business here in Canada, you probably already know that you do not have to pay income taxes up here unless your business is being run through a permanent establishment in Canada. However, ding, you still have to file a Canadian tax return and claim treaty protection just as you do in the United States. And ding, ding, guess what else? Even if you don't owe income tax in Canada, you are still required to collect and remit our national sales tax, known as the GST, on all the sales that you've made in Canada. I've done an entire video on this sneaky GST trap. Please go review it. It is really easy to get caught here. So check that one out before CRA comes knocking at the door and asks you why you didn't collect it. Article 8, Transportation, the trucking tax trap. Now, this might not apply to you personally, so if it doesn't, just skip to the next point. But if you own a Canadian trucking company, you're exempt from federal corporate tax under the tax treaty when you are delivering into the United States, and vice versa for American companies shipping up here to Canada. However, not all U.S. states honor the federal tax treaty. Looking at you, Texas. So basically, your Canadian trucking company traveling through the United States could be on the hook for state corporate taxes, even if the federal treaty says you're exempt. On the flip side, all 10 Canadian provinces honor the federal tax treaty with the United States. So if you're a U.S. trucking company, you won't be required to file and pay provincial corporate taxes. Article 12, royalties, a hidden gem. If you can make use of it, this one can be a game changer for you. Paragraph 4 of Article 12 defines what a royalty is. And guess what? It includes earn-out payments on the sale of a business if you structure the deal properly. Now, why is this massive for you? Well, if you're the buyer, the earn-out payments become deductible royalty payments. And if you're a seller, the payments are taxed as a capital gain. It's a win-win situation for both parties. I have structured deals like this before, and I have saved my clients tens and even hundreds of thousands of dollars for doing it. So a little tax planning tip for you. If you're selling a business with an earn-out, make sure the purchase agreement is worded carefully so you can take advantage of this. Article 13, capital gains. This is where people screw up big time. If I had done this video in order of importance, this is what I would have talked about first. Articles 13 sub 6 and Articles 13 sub 7 are the most overlooked and screwed up articles of the treaty, so listen up. If you as a Canadian taxpayer move to the United States, you can step up the value of your principal residence to its fair market value at the time you move to the United States, but only if you file the treaty election properly. And as an aside, unfortunately, this section of the treaty only applies to Canadian citizens moving to the United States. It does not apply to U.S. citizens moving from Canada to the United States. And here's the kicker. In the year you move, if you sell your home and close on it before you move to the States, you could potentially lose the benefit of the bump. And here is the huge mistake that most people make. Let's say you move to the United States on February 2nd, but your house closed on January 28th. In order to qualify for the treaty bump, you have to have owned your home at the time you moved to the United States. So in this January 28th, February 2nd scenario, if you file that person's tax return as a resident for the entire year in the United States, you will lose the benefit of the treaty bump. This is most likely an unintended result of the way the treaty was worded. In fact, it's 99% likely that it was unintentional. But here's a simple solution for you. Always check the residency timing before you sell your home. And where it's unavoidable, remember to file as a dual status alien 1040. Article 13 sub 7. This is the most important thing I will be discussing today. Have I got your attention? Now, do not screw up what I'm about to tell you. It could cost you or your clients hundreds of thousands of dollars if you do. And this subarticle of the treaty applies to U.S. citizens as well as Canadian citizens. Suppose you move from Canada to the U.S., and in that year you own a Canadian corporation. Article 13 sub 7 allows you to step up the basis in the shares of your Canadian corporation to their fair market value at the time you move to the United States. The treaty election must be filed timely and filed with the tax return for the year that you move to the United States, or else. With a little tax planning, we are able to extract the fair market value from that company to you at no tax cost. The IRS discusses this particular treaty article in Revenue Procedure 2010-19. Believe it or not, I have seen this twice in the last 18 months, and both times it was screwed up royally, and not by me. And for the record, you cannot just file an amended 1040 with a late treaty election and pay a $1,000 fine for the late treaty election. Revenue Procedure 2010-19 specifically precludes this. So please, when you get a new client that just moved from Canada, the first thing you should ask them is, do you have a Canadian corporation? And immediately explain to your client the mechanisms of the treaty that will allow them to get a bump up in the basis, and that their 1040 has to be timely filed, or else. If you take nothing else from this video, please take away this. Or better yet, visit my website, themactax.com, and get a hold of me right away, since there may be some Canadian planning we can do to benefit our mutual client even more. Article 18, pensions, alimony's dirty little secret. Okay, here's a bizarre one for you. The Article 29 savings clause does not include alimony. So what does this mean for you? If you are a U.S. citizen living in Canada, receiving alimony from a U.S. person, you could get double taxed with no foreign tax credit relief in either country. Seriously, that is brutal, right? Especially if you're a single parent. Thankfully, you will receive some unwritten administrative relief from the IRS, where they'll allow you a foreign tax credit on your 1040 in this situation. But technically, the law doesn't otherwise appear to allow a foreign tax credit in this situation. The moral of the story: if you're handling cross-border alimony, don't assume you're going to get fair treatment. Check it out with a pro. All right, my friend, that's it for today. And if you're dealing with any of these treaty issues, call me at MacTax.com, and I'll ensure that you don't end up in any of these treaty nightmares. And of course, as always, don't forget to subscribe for more tax savings tips. Until next time, stay sharp, stay compliant, and stay out of tax trouble. And I'll see you in the next video.